Goods and Services Tax, or GST, is a tax on the supply of goods and services. It's an indirect tax, meaning it is not directly levied on income or profits. Instead, it's collected at each stage of the supply chain, from manufacturing to retail. GST replaced many indirect taxes in India, like VAT, excise duty, and service tax. This simplified the tax system, making it easier for businesses to comply. GST is a destination-based tax, meaning the tax revenue goes to the state where the goods or services are consumed, not where they are produced. Before GST, businesses faced a complex web of multiple indirect taxes. Each tax had its own rules and regulations, creating confusion and compliance burdens. This system led to a cascading effect of taxes, where tax was levied on tax, increasing the final price of goods and services. GST replaced this complicated system with a single, unified tax structure. This streamlined the tax process, making it easier for businesses to understand and comply with tax laws. By eliminating the cascading effect, GST reduced the overall tax burden on businesses, making Indian goods and services more competitive. GST revenue is shared between the central and state governments. This sharing mechanism is designed to ensure that both levels of government have adequate resources. The central government collects integrated GST or IGST on interstate supply of goods and services. This revenue is then shared with the states. The states collect CGST, Central GST, and SGST, State GST, on the supply of goods and services within their respective states. The GST Council, comprising representatives from both the central and state governments, decides on the revenue sharing formula. Section 4. Value Addition and GST. Value addition refers to the increase in the value of goods or services at each stage of the supply chain. This process involves enhancing a product's value through various means such as manufacturing, marketing, or improving its quality. In the context of GST, tax is levied only on the value added at each stage, not on the total value of the product or service. This ensures that the tax burden is distributed fairly across the supply chain. For example, a manufacturer buys raw materials for 100 rupees and converts them into a finished product that sells for 150 rupees. This transformation adds value to the product. The value added by the manufacturer is 50 rupees, 150 rupees minus 100 rupees. This 50 rupees represents the additional worth created through the manufacturing process. GST will be levied only on this 50 rupees, not on the entire 150 rupees. This method of taxation helps in avoiding the cascading effect of taxes, making the system more efficient and transparent. Section 5. Input tax credit explained. Input tax credit is a key feature of GST that eliminates the cascading effect of taxes, which means that tax is not paid on tax. It allows businesses to claim credit for the GST paid on their inputs, raw materials, goods, services, while paying GST on their output, which are the finished goods or services. This helps in reducing the overall tax burden on businesses. For instance, if a retailer purchases goods worth 1,000 rupees with an 18% GST, which is 180 rupees, they can claim credit for this 180 rupees while paying GST on their sales. This makes the tax system more efficient and fair. This mechanism ensures that businesses are only taxed on the value they add at each stage of the supply chain, promoting transparency and compliance in the tax system. Section 6. Benefits of GST in India. GST brought significant benefits to the Indian economy, revolutionizing the way businesses operate. It simplified the tax system by consolidating multiple taxes into a single tax, reduced the compliance burden on businesses, making it easier for them to focus on growth and innovation, and eliminated the cascading effect of taxes, where tax is levied on tax. This led to lower costs for businesses, enhancing their profitability, which could then pass on the savings to consumers in the form of lower prices, making goods more affordable. GST also created a uniform market across India, promoting fair competition, as businesses no longer had to navigate different tax rates and regulations in different states, simplifying interstate commerce. This boosted interstate trade and commerce, contributing significantly to economic growth and development. Overall, GST proved to be a transformative reform, reshaping the economic landscape, making the Indian economy more efficient, competitive, and integrated, paving the way for a brighter future.